Welcome back. Today we're looking at an analysis report that puts forward a pretty bold contrarian buy-the-dip thesis for Rezolve AI, that's RZLV, after its Crown Peak acquisition.
Right. The core idea is that the market is fixating on the debt and completely missing the projected revenue story.
Exactly. Let's dive right in and talk about how to make that story, that argument, even stronger.
Okay, so the whole thing really hinges on this idea of massive, rapid growth. And, while that's exciting, it's also the first place a skeptical leader is going to push back. It needs more scaffolding.
I see that. You've got this solid foundation with Crown Peak's existing $70 million in revenue, which is great. It's a real number. But then you have this leap to $500 million.
It's a huge leap. And that's really the first point. So while the report establishes this instant revenue explosion pillar, it cites Crown Peak's current $70 million and the forward guidance of $150 million ARR for 2025, and then that $500 million target for 2026. The connection between the current scale and that ultimate target, it just lacks structural support.
That massive jump is the whole bull case, right? It's what gets you to that $10 price target.
It's everything. But right now, it feels a bit like you're just telling the reader the destination, but not, showing them the map of how to get there.
Yeah, which leaves a logic gap.
A big one. And that's the weakness. Simply saying Trojan horse cross-sell strategy isn't enough. Not for this kind of acceleration.
So just repeating the buzzword doesn't do the work.
Not at all. I mean, the sheer scale of it means sophisticated readers might just dismiss it as wishful thinking without some hard numbers to back it up.
So we need to go from just stating the target to actually modeling the path, grounding it in, plausible metrics.
Precisely. The suggestion for improvement here is to dedicate a specific quantitative section to modeling the required success metrics.
Okay.
This makes the target feel less like an aspiration and more like a plan. It shows you've done the deep work on execution.
Right. So let's talk specifics. How do you quantify that? How do you make a jump from 70 million to 500 million feel plausible?
You have to break it down to the client level. The report says there are 400 plus enterprise clients. Okay, great. So instead of just repeating the big number, quantify the required cross-sell performance.
Calculate the average deal size needed from that base.
Exactly. You need to calculate the average incremental annual contract value, the ACV, per client to hit that goal.
So you're breaking the big, scary number down into smaller, digestible units.
Yes. For example, the report could model it out. Something like, to reach 500 million ARR by 2026, Rezolve must successfully cross-sell a new ACV of $1 million to, say, 86% of its existing 400 clients.
Or you could frame it as selling a more premium product to a smaller group.
Right. Or successfully sell a $1.5 million AI product to 50% of that base. Suddenly, the math starts to feel real. You're showing the pathway.
That's a good point. And maybe you could get even more specific, because not all of those 400 clients are created equal, are they?
That's an even better approach. Some will have much deeper pockets. The report could identify which verticals, maybe which specific named clients, the Sephoras or Tommy Hilfigers of the world, are best positioned to drive that initial massive expansion.
So you're demonstrating that you know where the big money is. You could say something like, Tier 1 retail clients represent 60% of the immediate opportunity and require an average ACV uplift of X dollars.
Yes, that shows a real strategic allocation of resources. It moves the argument from just aspirational to operational. It's much more convincing.
Okay, that makes sense. Let's shift gears to the risk analysis. This is so critical for a contrarian piece, especially when the stock dropped because of debt fears.
Absolutely. And the report does identify execution risk, which, is fine. It's standard stuff for any M&A deal.
But it feels a bit generic here.
It is. The analysis needs to go deeper. So the report correctly identifies execution risk as a major challenge. But this risk needs to be explicitly tied to the potential failure of that Trojan horse cross-selling strategy, because that's the whole reason for the deal.
Right now, it's just listed next to debt and cash burn. It's treated like another bullet point. But in this case, execution failure it's existential, isn't it?
It's the single biggest threat. And that's the weakness here. The whole point of buying Crown Peak was to get access to those 400 plus clients. If the integration is messy or slow,
you never get a chance to sell them anything new.
Exactly. You sabotage the entire rationale for the acquisition. You damage that customer relationship, and the opportunity to cross-sell the brain suite just evaporates.
Consequences of those fumbles.
That's it.
So the suggestion is to refocus the risk section to analyze potential client erosion. You have to talk about the fragility of that trusted relationship that you need for the cross-sell to work.
Okay, so to make that actionable, what are the specific failure modes you'd highlight? What does that failure look like from the client's perspective?
Well, the report should explore what could go wrong with the existing CrownPeak product. For instance, what if post-acquisition, platform stability takes a hit? Or tech support gets worse because of restructuring?
These are big enterprise clients. They won't tolerate that.
Not for a second. They're trusting Rezolve with their mission-critical digital experience. Any service degradation could lead to churn, and that destroys the very revenue base you're trying to build on. It undermines the whole starting point.
If the foundation crumbles, you can't build anything on top of it. That makes perfect sense. What about the cross-sell itself? Could that strategy backfire, even if the integration goes smoothly?
That's a really sharp point. A great piece of risk analysis would consider that. You have to look at the client relationship from their side.
Okay.
Is there a risk that this aggressive brain suite cross-sell feels too pushy or just premature? Large companies value stability. If you come in too hard with a new product before they even trust the new operational structure,
You could alienate them. They might see it as a distraction or just an unnecessary cost.
exactly. It could lead to resistance, not adoption. So analyzing that threat, the psychological barrier, adds a whole new layer of depth to the risk section. It shows you've thought about the human element, not just the technical one.
It becomes a focused, strategic threat assessment specific to this deal. Much stronger.
Much.
All right, let's move to the third key area, valuation. This feels critical. I mean, the market sold off RZLV because of the debt, but the analysis uses a valuation metric that ignores the debt.
It feels like a missed opportunity. Or worse, a flaw.
Yeah.
And that's the topic sentence here. The argument for a valuation disconnect is compelling, but it relies on comparing market cap to projected sales, which overlooks the significant $150 million debt, leading to an artificially favorable sales multiple.
The weakness is just so clear. In this kind of analysis, especially with a debt-financed acquisition, only using price to sales it's misleading. The debt is the reason for the stock drop. It's the whole story. So the valuation section has to tackle it head on.
You can't argue the debt is mispriced if you don't include it in your own valuation metric. It just undercuts your credibility.
So the suggestion here has to be a change in methodology.
Absolutely. To really confront the market's main fear, the report needs to introduce and use enterprise value, or EV, when it's talking about sales multiples.
Because EV includes debt, it gives you a complete picture of what it actually costs to acquire that revenue stream.
It's the honest way to do it. And it shows you're not afraid of the market's biggest concern. The analysis needs to walk the reader through it, though. Give them the concrete example.
So literally spell out the calculation.
Yes. Clearly state the formula. EV is market cap plus debt minus cash. Show the math with the current numbers. For example, you'd write $800 million market cap plus $150 million in debt equals a $950 million enterprise value. Assuming minimal cash, you're being totally transparent.
And that's where the real power is. You use that new, bigger number to recalculate the sales multiple.
That's what makes the contrarian argument so much more robust. You recalculate the valuation disconnect using EV to projected sales. So if they hit that $150 million ARR target for 2025,
your EV is 950, your sales are 150, so your multiple is about 6.3.
6.3x.
And that 6.3x is your true debt-aware valuation metric. That's the number you can confidently compare to peers. And that's still low for the sector.
Very low. When you compare that 6.3x to the 10 to 20x multiples that other high-growth AI SaaS companies get, your argument is suddenly so much stronger. It's more sophisticated, and it's debt-aware. It proves the stock is cheap even after you account for the debt.